Hi everyone, very good afternoon and welcome back to CGB Mentors. So in today's session, we are going to discuss the top 50 MCQs of Module C, that is credit management. So now let's have a look onto it. See, number one, a bank issues a letter of credit on behalf of its customers in favor of a supplier. This is an example of fund-based short-term credit, fund-based long-term credit, non-fund-based credit, unsecured priority sector loan. So as we all know, this is called as non-fund-based credit, right? Over here, we are not disbursing any kind of fund, but we are just providing the guarantee that if the party is not able to pay it, the bank is going to pay, right? Next is in the context of credit risk management, which of the following tools are used to quantify and manage the credit risk exposure? So over here, option B, that is PD, LGD and EAD, these are the tools that are used. PD is probability of default, likelihood that a borrower is going to default. Then we have LGD, that is loss given default, portion of the loan that the bank is likely to lose if a borrower defaults. EAD is exposure at default, that is total value at risk at the time of default, right? Now we have option number 3, that is under credit management. Which of the following best illustrates concentration risk and is mitigated through exposure limits? Concentration risk यहाँ पे क्या होगा? High exposure to a single sector or to a borrower group. ठीक है, किसी भी borrower group या single sector को if you are giving too much of the loan or funds, that is called as the concentration risk. Then we are having under RBI PSL framework, how is credit flow encouraged in district with low per capita priority sector lending? जहाँ पे भी ऐसी on all those district where the priority sector lending per capita is really less, over there RBI assigns a higher weightage. ठीक है, जहाँ पे ज़्यादा weightage दिया जाता है. So that is why PSL loans in such districts, they are weighed at 125%. We give them higher weightage, right? As per the RBI guidelines, what is the minimum reset frequency for interest rates on loans linked to external benchmarks? So every 3 months you have to reset the loan rates which are linked to the external benchmark. This is as per RBI guideline. Now, which of the following loans is exempt from the base rate MCLR external benchmark guidelines? कौन से लोन है जो exempt रहते हैं? So, loan against borrower's own fixed deposit is the kind of loans. There are other loans also. For example, employee loans, CEO loans, loans under government refinance scheme. All these, they are exempted from the pricing rules, right? Under RBI's interest rate regulation. Now, when does a term loan become an NPA as per the RBI norm? So, if the interest and principal that remains overdue for a period of more than 90 days, then it is labeled as NPA. Right? Then you have under the MCLR framework, the marginal cost of fund, how it is calculated, right? Under marginal cost of lending rates. So, over here, we calculate it through 92% marginal cost of borrowing plus 8% return on net worth. This is how we calculate the marginal cost of funds, right? So, what is your additional borrowings that you are doing? What is the marginal cost for doing that? Plus 8% is something that you also want return. So, whenever I am quoting the interest rate to somebody, I'll quote what along with my cost as well as the profit that I want to make in, right? So, next we have composite PSL target calculation for a domestic bank. So, ABC Bank has the following figure, that is net bank credit 8,000 crore. Okay. RIDF NABARD deposit 1,000 crore, other eligible investment 500 crore, exemptions are given 500 crores, then credit equivalent of off-balance sheet exposure given 10,000 crore. Now, you know whichever is higher, ANBC or CEOB, right? As per that, you have to calculate your PSL target. So, let's have a look onto it. ANBC is equals to your NBC, the credit IRDF deposits that you have made, other investment less exemption, it is 9,000 crore, higher of ANBC or CEOB 10,000 crore, and 40% of that is your PSL target, right? Now, a regional rural bank has an ANBC of 6,000 crore. Now, as per the RBI guideline, what is the minimum required lending for the following category? Agriculture, SME, SMF, weaker sections को कितना कितना देंगे? So, options have been given to you. The answer for that is for agriculture 18%, SMF 10%, weaker section 15%. That's the compliance you have to do. A borrower applies for a 36 lakh housing loan in Delhi for a house with a stamp duty value of 44 lakhs. The project is a part of affordable housing scheme. Now, does this housing loan qualify under the PSL? So, over here, yes, both the value, loan and property values, they are within the PSL limit. So, what are the PSL limits? As per RBI guidelines from April 1st, 2025, in metropolitan cities where the population is greater than 50 lakhs like Delhi, maximum loan amount should be 50 lakh, maximum property value should be 63 lakhs. So, in this case, both the conditions are fulfilled and hence it would be taken under PSL. Now, a bank has tier 1 capital of 8,000 crore. It has the following exposure with one borrower. So, funded exposure 400 crore, non-funded exposure 300 crore. Non-funded exposure like letter of credit, guarantees, etc. Now, exposures after CRM is 600 crore. So, is this considered a large exposure and what value must be reported to RBI under the large exposure framework? See, total exposure before CRM is 700 crore. Large exposure threshold is 10% of tier 1 capital. So, in this particular case, it's not a large exposure. So, all exposures above 10% must still be reported even before CRM, right? So, yes, reported value is 700 crore. Now, Bank XYZ has tier 1 capital of 10,000 crore. It has exposures to 3 connected NBFCs, right? NBFC A 1000 crore, NBFC B 800 crore, NBFC C 900 crore. Now, has the bank breached the large exposure framework limit for group exposure to connected NBFCs? So, over here, see, total exposure 2700 crore to the connected NBFCs. What is the limit over here? 25% of the tier 1 capital. So, tier 1 capital ka 25% is 2500 crore and yes, there has been a breach by 200 crores. ठीक है, 200 crores का आपके पास में breach है. Now, next is a bank invests 500 crores in a collective investment undertaking with following known breakdowns. Company A 100 crore, Company B 80 crore, Company C 40 crore and there is a remaining exposure of 280 crores, right? Bank has invested but some of the exposure remains undisclosed. So, bank's tier 1 capital is 20,000 crore. They are asking under large exposure framework, how will the bank treat the unknown part of the investment? Bank कैसे treat करेगा unknown part of the investment? Let us look at it. This is a very good question. So, over here under partial look through, if 0.25% greater than 0.25% of the eligible capital is unknown. Over here, what is your unknown exposure? 280 crore, which is obviously greater than 50 crores, right? So, hence 280 crore would be treated as an exposure to single counterparty and it obviously why such kind of regulation exists so that we can prevent the banks from hiding risk in the structured investment. So, yes, it is going to be treated as an exposure. Right? Now, next question is, two borrowers, Company X, Company Y meet the following conditions. Company X owns 60% of Company Y's voting share. So, that means they are connected. They share same source of 80% of their funding. Combined exposure is 2800 crores. Bank's tier 1 capital is 10,000 crore. Now, how this exposure is going to be classified? So, over here, there would be they'll be treated as connected counterparties with 28% of the exposure and hence it has breached the LEF norms, right? So, that is another thing. Now, question number 16, it has over here, you have to calculate what is the negative carry on CRR. Required CRR is 4%, marginal cost of fund is 7%. So, you have to apply a formula directly. Negative carry is going to be CRR multiplied by marginal cost divided by 1 minus CRR. So, CRR percentage is given, marginal cost is given, again divided by 1 minus 0.04 and you will get your answer. Now, a bank lends two fixed rates term loans. Loan A 100 crore for 2 years, loan B 100 crore for 5 years. If the MCLR is 7% and the spread is 1% and tenor premium is 0.25 is applicable for loans greater than 3 years, what is the final rate? So, in this particular case, what is going to be the rate? 7% plus 1%. But over here is this obviously exceeds 3 years. So, we have to apply the tenor premium as well. So, for loan A, 7% plus the spread 8% for loan B, which is for 5 years. So, over here you have to apply the tenor premium as well. Right, it would be 8.25%. Next, we have a bank offers housing loans linked to the RBI repo rate with a spread of 2.5%. Now, if the repo rate is reduced by 50 basis points and the bank reflects this fully, what is going to be the new lending rate? So, अगर repo rate आपका कम हो गया है, now it is 6%, right, with a spread of 2.5, so 8.5 is going to be the correct answer. New repo is 6.5 less 0.5 is 6%. Lending rate is 6% plus 2.5%. Now, borrower X has two floating rate loans. Loan A is MCLR linked with reset frequency of 6 months. Loan B is repo linked, that is external benchmark. Now, what is the minimum reset frequency that has been mandated for these kind of loans? So, over here, loan A, this is as per the bank policy, the reset is going to happen. For the external benchmark, you have to see this every 3 months, right? You have to visit us every 3 months and a reset should happen. Now, next is Bank Y has the following data: marginal cost of borrowing 7.25, return on net worth 13%. Now you have to calculate marginal cost of funds. Marginal cost of lending 92% with your marginal cost of borrowings plus 8% multiplied by return on your net worth. Directly you will multiply and 7.74 is your answer. Now, a bank gives the following loans: 50 crore loan to staff at concessional rate, 100 crore fixed rate loan 4-year tenor, 25 crore loan against term deposit, 40 crore floating rate housing loan sanctioned in 2014. Remember that bank's base rate at that time was 9%. So, which of the above violates RBI exemption norm? See, over here every other is fulfilling, but this option is not fulfilling because this loan has been sanctioned in 2014 at 8.5%, but at the same time before 2016 it was mandated that the banks are going to give the loan at base rate, and obviously they have not fulfilled the base rate requirement, so that is why it is violating it, right? So over here option A, only loan D. Employee loans are exempt. Fixed rate loans greater than 3 years is exempt. Loan against own deposit exempt. Floating rate loan pre-April must be base rate, right? So that is something is violating over here. Next is the loan account was classified as substandard on 1st April 2023. ठीक है? On 30th June the account remains unpaid and is backed by the collateral worth 5 lakh. Outstanding loan is 10 lakhs. Now what is the total provision that the bank should make on 30th June 2024? Over here, see, substandard period has ended on 31st March 2024. That is a 12-month period is allowed once the asset has become NPA. So now this asset is doubtful asset, right? So for doubtful asset, for secured portion 25% provision is needed to be made, and for the unsecured portion 100% provision needed to be made. So your total provisioning requirement is going to be 6.25 lakhs, right? Now, a bank has sanctioned a 100 crore infrastructure loan with an original date of commencement of operations as on 1st April 2021. But till 1st April 2025, the commercial operations have not started. So now what is the required provisioning, assuming no restructuring is done? So delay is beyond 2 years, obviously. So now 4 years delayed, and as per the IRAC norm, provisioning required is 5% of the outstanding. So 100 crores multiplied by 5%, 5 crore is something that the provisioning is required to do by the bank. A cash credit account has a sanctioned limit of 50 lakhs. For the 90 days, there have been no credits and the outstanding balance is 52 lakhs. Okay. What is the classification of the account and what would be the provisioning requirement if 30 lakhs is unsecured? Agar 30 lakh unsecured hai out of this though. Now see this. Over here, as per the RBI guidelines, obviously this is an NPA. ठीक है, 52 lakhs is outstanding, right? So over here, what you have to do is, if the asset is substandard, provisioning is 15% for secured portion, 25% for the unsecured portion. So over here, 30 lakhs is unsecured, right? So 30 lakhs multiplied by 25%, that is 7.5 lakh. This is something which is needed, right? Now, under the going concern assumption, how are the assets generally valued in the financial statement? कैसे value किया जाता है? On the basis of obviously historical cost, we do not follow the market pricing. हम market pricing इसमें follow नहीं करते हैं. We think that whatever the cost, whatever the amount that has been incurred for purchasing the asset is something that we are going to classify. Now, which of the following is mandatorily disclosed in notes to accounts? क्या disclose mandatorily किया जाता है notes to accounts में? Total number of employee, market value of shares, reconciliation of shares outstanding at the beginning and at the end of the period, dividend history over the past 3 years. So over here, reconciliation of share outstanding is mandatorily be a part of your notes to accounts. Now, which of the following would be classified as a financing activity in a cash flow statement? So over here we understand issue of equity share. This is a part of financing activity. Equity share, preference share, debentures, bank loan, etc. payment of this or receipt of the money is clearly classified as a financing activity. Now, as per the Companies Act, which of the following type of companies is exempt from preparing a cash flow statement? Listed company, dormant company, private company or company engaged in NBFC. Clearly a dormant company is exempted from preparing because obviously they are not functioning. Which of the following is the primary focus of the fund flow statement but not of cash flow statement? So, fund flow, we prepare a working capital changes related statement, which we usually do not do in case of cash flow statement, right? Next is in preparing projected financial statements, what minimum capital adequacy ratio must banks maintain under the Basel III, right? So, this is 6% in tier 1, 9%, right, that is required. Now, next we have a company has total current assets of 4 crores and total current liabilities of 3 crore. What is its net working capital ratio and what does it indicate? ठीक है, यहाँ पे आपसे net working capital ratio पूछा है. Let's calculate it. First of all, net working capital is current asset less current liabilities, that is 4 crores less 3 crores is equals to 1 crore. Now, NWC ratio is NWC divided by current assets. So, 1 divided by 4, 25% is your net working capital ratio, right? Then you have a company's profit before tax is 10 crore, net sales is 100 crore, depreciation is 5 crore, interest is 3 crore. So, what is its EBITDA margin? What you have to do is, this is PBT given to you, depreciation interest is given to you, you just have to add it, PBT plus interest plus depreciation, tax if it would have been given. So, your EBITDA margin is 18 crores and EBITDA margin divided by net sales, 18 divided by 100, 18% is your answer. A company has net profit of 12 crores, depreciation is 3 crores, term loan installment 6 crores, interest on term loan 2 crore. What is this gross DSCR, right? Debt service coverage ratio. So, over here cash net profit plus depreciation 15 crore is there. What is the DSCR it has to do? So, divided by installment and interest. So, your installment is somewhere 6 crore, interest is 2 crore. This is the full debt that you have to service and what is the amount that you have to serve it? So, obviously 15 plus 2, interest you will also add because interest will be a part of your income. Net profit में से आपने interest हटा दिया होगा, so that is why I added back. Divided by 8, that is your installment plus interest. Now, a bank reports gross NPA of 1000 crore and provisions made for NPA at 750 crore. So, what is the provision coverage ratio? Very clearly, this is 750 divided by your gross NPA. So, that is your provision coverage ratio. Then you have in a firm's EBITDA is 100 crores and long term debt is 400 crores. So, what is its vanquish ratio? Vanquish ratio आपका क्या बताता है? That what is your long term debt and how much earning you are having. So, if I have 400 crore worth of debt and I have 100 crores of earning, then I would need at least 4 years to cover that, right, or to repay it. Now, a bank earns 10,000 crore in interest income and spends 6,000 crore in interest expenses. If the average interest earning assets are 2 lakh crore, what is its net interest margin? So, over here, you just have to find your net interest income, that is 10,000 less 6,000, 4,000 crore. Then your net interest margin is 4,000 crore divided by your average interest earning asset, that is 2 lakh crore, and multiplied by 100, it would be 2%. Now, next you have core current assets adjustment. A company provides the following data, that is a total current assets 450 lakhs, core current assets 100 lakhs, current liabilities 180 lakh. Now, using the third method, you have to calculate the bank's contribution if the borrower is contributing 25% of your real current assets. Over here, see, they have already given you a hint that in what method you have to calculate it. So, over here, first of all, calculate the real current assets, that is total current assets less core current assets, it gives you 350. Fine. Then working capital gap would be 350, that is your real current assets less current liabilities of 180. Borrower contribution कितना होगा? 25% of your real current assets, that is 350 lakhs. So, borrower is contributing 87.5. How much bank is going to contribute? That is your working capital gap less your borrower's contribution, that is 82.5. Now, next you have the cash budget method with seasonal variations. So, there is a seasonal business, it has following monthly cash deficits 25 lakh, 18 lakh, 32 lakh, 28 lakh, 40 lakhs and 20 lakhs. Now, if the business decides to maintain a buffer of 20% above the peak deficit, then what is the total working capital limit financed by the banks? ठीक है, यहाँ पे आपका peak deficit अभी तक कितना है? Obviously, See, 40 lakhs is the peak deficit. So 40 lakhs plus we'll do the 20% buffer, and 48 lakhs is something which is the total working capital limit that would be provided to us. Now in Indian companies importing goods worth $1 million under suppliers credit with following term: LIBOR is 2%, spread is 250 BPS, maturity period is 1 year, exchange rate is given. So now what is the all-in cost in percentage term? Just you have to add these two, benchmark rate plus what is the spread, right? That is the direct answer. Now a company has the following details: total current assets, core current assets. Now this question I have given you for your practice purposes. You can do it. We have done the similar question before. Now next is partial credit enhancement. So a bank has provided for a corporate bond issue of 50 crores. If the bond rating improves from BBB plus to AA minus, reducing the risk weight from 150% to 50%, then what is the reduction in capital requirement for the bank? So over here, see, initial risk weight was 150%. So what was the capital requirement? 150% multiplied by 9% multiplied by 50%, right? This was the capital requirement. This is as per the Basel norms. Now, if the new risk weight is 50%, so now 50% multiplied by 9% multiplied by 50 crores, that is 2.25 crores. So what is the reduction in capital requirement? Because your risk weight has reduced, so now you can save more capital. Now, in an export factoring under non-recourse basis, what must the export factor ensure while processing the invoice? That invoice explicitly states payment should be made to the import factor. When the export factoring is done, the export factor must ensure that the invoice sent to the foreign buyer includes a notation that the payment must be made directly to the import factor, so it ensures clarity and proper routing of funds. Now, which of the following is the key difference between recourse and non-recourse factoring? So over here, the credit risk is the major factor of difference in both the kinds of factoring. So option number B is the correct one. What is the key regulatory condition banks must meet before issuing non-fund based credit to the customer without existing fund based limits, right? So over here, customers must declare that they have not availed any fund based facility from other banks, because it is very, very important. If we are issuing a letter of credit, we have to see that from what all other areas you have taken funds. Next, according to RBI guidelines, what is the minimum overall margin required when banks issue guarantee on behalf of stock brokers? See, in this case, 50% with at least 25% in cash. This is what is required, right? So that risk can be mitigated. Now, in the context of INR denominated trade credit, which of the following type of trade credit involves an overseas bank or institution paying the supplier on behalf of Indian exporter? So in this case, this is the phenomena of your buyer's credit. In this, overseas bank pays the supplier upfront and Indian importer then repays the lender. And what happens in the supplier credit? Supplier themselves offer deferred payment terms directly. Now, next is, as per RBI norms, what is the maximum permissible all-in cost ceiling? So, whatever is your benchmark plus 250 BPS, that is the maximum permissible benchmark ceiling. Now, in the equal principal payment plan for a loan of 10 lakh at 12% annual interest with monthly payments over 1 year, how does the interest component change month on month? कैसे ये change होता है and how does it changes? So, interest decreases monthly because equal principal is being paid, so your principal is getting reduced with the time, so obviously your interest component is also going to decrease. Next is, a bakery incurs monthly fixed cost of 50,000, variable cost per cake is 100, sells the cake at 200. So how many cake must it sell to reach its break-even point? So for arriving at a break-even point, it has been asked in quantity. So fixed cost divided by contribution per unit, fixed cost is given. Your contribution per unit is 200 minus 100, that is 100. So easy. Over here, fixed cost is 50,000, contribution per unit is 100, and you have got the answer of 500 cakes. A loan of 10 lakhs has an interest coverage ratio of 3. If the annual interest rate on the loan is 1 lakh, what is the borrower's EBIT? Okay. So over here you have to twist the formula. ICR is equals to what is your what is your EBIT divided by what is your interest. Both the factors have been given to you. So over here, what we will do is ICR multiplied by interest, right? You will take the interest from denominator along with ICR, and that would be 3 lakhs. So these were your questions, 50 questions on module C, credit management. I'm sure you will practice for the numericals. This is it for today.